During this month of July, on Money Monday, we're talking about saving for retirement. It's so important. And today we're joined by Chad Waddups, Vice President of Investment and Insurance Services, talking about the difference between a 401k and an IRA. And, you know, just during the commercial break, I was asking you questions that I should know the answer to. I think people are confused about the difference. So let's start with the 401k.
Yeah, so the 401k is an employer-sponsored plan. The IRAs, which we'll talk about, are individual-sponsored plans, but a 401k is set up by your employer. The employer then allows the employee to contribute to that account. The employer decides which investment options are available in the account, but it's the employee who gets to pick from those options which they want to use for their retirement savings. And the nice thing about a 401k is many plans, more than half of them that are out there, the employer also offers a matching contribution, which is a great way to accelerate retirement savings even further.
And I've heard many times that if your employer offers a matching, make sure you take advantage of it because it's free money. Absolutely.
It's one of the few ways you can get free money towards your retirement. So if your employer offers that, absolutely, it would be silly not to take advantage of it.
Okay, let's talk about an IRA. What exactly is that?
So an IRA is an individual retirement account as opposed to the 401k, which is an employer-sponsored plan. There's two main types of IRAs. There's a Roth IRA and there's a traditional IRA. If we look first at what the traditional IRA is, anybody under the age of 70 and a half can contribute to a traditional IRA, regardless of your income. And when you make that contribution amount is tax deductible. So you can actually lower your tax liability by contributing. And later on, when you start taking that money out, so you are able to do that tax-free at age 59 and a half. You're required to take that money out starting at age 70 and a half. That's when you'll pay taxes on it, later on when you pull the money out. A Roth IRA is a little bit different in that the contributions you make today are not tax deductible, but the benefit is later on when you pull that money out, there's no tax liability at that point.
Now, if you do have an employee-sponsored 401k or employer-sponsored 401k, you can also contribute to an IRA, so you can do both there.
You can, absolutely. That's good news is that you don't have to choose one over the other. They can work in partnership to really build a successful retirement.
But the government has set limits on how much you can contribute.
They do. With an IRA, for this year, the maximum contribution is $5,500. If you are older than 50, you can add $1,000 to that for a maximum of $6,500. The 401k contribution limits are actually set at $18,000 for this year.
But whatever you do out of this entire conversation, just start contributing to a retirement. Whatever you get out of this, that's the most important thing.
That is the most important thing. And whether you're 60 or 20, it's important to start contributing to these plans. It's really the way that we can save for a successful retirement.
Well, Chad, thanks so much for joining us. If we want more information, because this is confusing, where can we get it?
You can get it from Mountain America through one of our branches, one of our many branches, or you can go to Mountain America's website at macu.com, and we'll help you out.
All right. Thanks so much for joining us.
You bet.
Andrew.
All right, guys, some good tips thinking for the future when we